Hello and welcome to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. With the market still full of uncertainty, savvy investors know that opportunities hide in plain sight, especially when it comes to dividend stocks. In today's video, we're diving into 3 high-quality UK dividend stocks that are trading at a discount right now. Whether you're looking to boost your passive income or scoop up long-term value plays, these picks could be just what your portfolio needs. If you enjoy these 3 dividend stocks to buy videos, make sure to hit the like button. If we can get over 100 likes, I'll keep the series going and bring you more stock picks every single month. Anyways, let's now have a closer look at the first stock in today's video, which is none other than Clarkson, stock ticker CKN. Clarkson plc is a leading UK-based provider of integrated shipping services renowned for its comprehensive offerings across the global maritime industry. Established back in 1852 and headquartered in London, the company operates through 4 primary segments: broking, financial, support and research. With a global presence in 25 countries and a team of over 2,100 specialists, Clarkson is committed to enabling smarter, cleaner global trade through its integrated service offerings and technological advancements. When having a closer look at their price, year to date they are down 8.6% with a current price at £36.15. They are part of the industrials industry, have a market cap at 1.1 billion, went public in 1986, have a 9-year dividend growth streak and a 5-year dividend growth rate at 6.47%, with a yield at a very healthy 3.04%. Clarkson remains a strong UK dividend stock for November 2025, underpinned by its consistent financial performance and shareholder-friendly policies. The company has maintained a progressive dividend policy for 9 consecutive years, reflecting its commitment to returning value to shareholders. In the first half of 2025, Clarkson declared an interim dividend of 33p per share, up from 32p in 2024, demonstrating its resilience in delivering shareholder returns. Despite a slight decline in revenue and profits due to market conditions, the company reported 206.2 million in free cash resources, highlighting its strong cash generation capabilities. Clarkson's diversified business model positions it well to navigate market fluctuations and capitalise on global trade dynamics. With a robust balance sheet and a history of reliable dividends, Clarkson offers an attractive proposition for income-focused investors seeking stability and growth in the maritime sector. And if we have a look at the analyst consensus right now, they actually have it as a strong buy with a price target at 4,121p, which is 14% above the current price. They also score pretty well overall on the stock rank score at 71, with having a very high quality score at 91 and then a value score at 55, followed by a momentum score that is now at 44. When having a look at their 12-month Wall Street estimates, this also backs up that right now Clarkson is trading at a discounted price. They believe on the lowest forecast it could see a 12% upside, being valued at 4,040 GBX. On the average forecast, having a 16% upside, being valued at 4,200 GBX. And on the highest forecast, having a 26% upside, being valued at 4,567 GBX. When plugging in my numbers for their intrinsic value, on the base case, they were also valued at around 4,612 GBX, which would mean that they are currently undervalued by 22%. I think that Clarkson stands out as a premier UK dividend stock in November 2025 as it offers a compelling mix of income, stability and growth potential. With a progressive dividend policy that's been in place for over 9 years, Clarkson has consistently increased its dividend annually, underscoring its commitment to delivering shareholder value. Beyond its financial metrics, Clarkson's diversified business model, encompassing broking, financial services, support and research positions it well to navigate the complexities of the global maritime industry. The company's forward-thinking approach, including investments in digital products and maritime energy transition analytics, demonstrates its adaptability and readiness to capitalize on emerging trends. With a strong cash position and an asset-light business model, Clarkson is well equipped to weather market fluctuations and continue its trajectory of sustainable growth. For income-focused investors seeking a blend of yield, stability and growth, Clarkson plc presents a compelling investment opportunity. How would you feel about receiving a free share of another very high-quality UK dividend-paying stock? Well, I've teamed up with XTB UK as they are currently running a pretty awesome promotion where new users can get a free Rolls-Royce share just for signing up. Yes, it's that simple. All you need to do is click my link in the description down below, download the XTB app, open an account, verify your account, make your first deposit, and then you'll receive a free Rolls-Royce share. Remember that your capital is at risk, the value of stocks may fluctuate, and there is limited availability and T's and C's do apply. But it really is that simple, and the best part is XTB isn't just a trading platform, it's also a solid place to learn. They've got loads of free investing education, as well as keeping you up to date with the latest market news. You can see here the interface is clean, beginner friendly, and gives you access to both UK and global markets. There's over 6,600 stocks available on XTB alongside 1,800 ETFs. Plus, if you're in the UK, you can even open a stocks and shares ISA account, which means your investments can grow completely tax-free. And you'll even receive an industry high 4.25% interest on uninvested cash. If you want to grab your free share, make sure and use my referral link in the description down below. Just remember, as with any investment, your capital is at risk. The value of your investments may go up or down. There is limited availability and T's and C's apply, so make sure you're quick. This offer is only available for a limited time, and once all the free Rolls-Royce shares have been claimed, that's it, they're gone. So don't miss out. The next stock we're going to have a look at is one that I've briefly looked at in the past, but it came more to my attention with the recent share price drop. That stock is none other than RS Group plc, stock ticker RS1. The company is a UK-based global distributor of industrial and electronic products and services. The company supplies designers, builders and maintainers of industrial equipment and operations with a wide portfolio including automation and control, electrification, mechanical and fluid power, test and measurement, and personal safety products. It operates in around 30 countries, stocks hundreds of thousands of products sourced from thousands of suppliers, and supports customers across design, build, maintain, and repair phases of industrial asset life cycles. As we can see on screen, year to date they are down 15.63% with a current price at £5.75. They're part of the industrials industry, have a market cap at 2.69 billion, went public in 1986, have a 9-year dividend growth streak with a very healthy 5-year dividend growth rate at 7.59%, and a very nice yield that currently sits at 3.9%. And when I had a closer look at RS Group's recent earnings call, it showed resilience despite softer industrial demand. Revenue came in at 2.9 billion, down just 1% year on year, with management noting growing market share and improving underlying demand. Adjusted operation profit was 274 million with a 9.4% margin, supported by strong cost control and integration efficiencies. A major positive was free cash flow rising 42%, 214 million, driving cash conversion up to 111% from 83%, a clear sign of tighter financial discipline. The company also strengthened its balance sheet with net debt to EBITDA improving to 1.1 times, while the full year dividend increased 2% to 22.4p, reflecting continued shareholder confidence. RS Group delivered 29 million in cost savings this year, and it's now 38 million across the last 2 years, and said acquisition synergies are ahead of plan. Overall, while revenue growth was muted, RS Group demonstrated robust operational execution, strong cash generation, and a solid financial position, positioning it well for recovery when industrial markets rebound. And as we can see right now, the analyst consensus is that it's a buy with a price target around 719 pence, which would be 25% above the current price. They also score very nicely on their stock rank with a stock rank at 77, and they do have a very high quality score at 94 with a value score at 59, and then due to that share price decline over the past few months, that is why the momentum has been coming down, so it's now at 45. When having a closer look at their 12-month Wall Street estimate, we can see on the lowest forecast they do actually see a potential slight downside with the price being 484 GBX. On the average case though, they do see around a 28% upside with the price being 738 GBX. And on the highest forecast, they have it priced at 913 GBX, which would be a 59% upside on the current price. When we have a close look at their intrinsic value, on my base case price, when plugging in my numbers, it came out of being valued at 830 GBX, which would be a 31% undervaluation on the current price, and that is why I feel like RS Group stands out as a compelling UK dividend stock for November 2025. It is offering a robust combination of income, stability, and growth potential. With a forward dividend yield of approximately 4.05%, it provides investors with an attractive income stream, especially appealing in the current low interest rate environment. The company's commitment to returning capital to shareholders is evident, having increased its dividend annually for those past 9 years, as I've already highlighted. Beyond its financial metrics, RS Group is a leader in the industrial and electronics distribution sector, serving a diverse global customer base. Its strategic focus on automation, electrification, and sustainability positions it well to capitalize on long-term industrial trends. The company's strong cash flow generation, efficient operations, and solid balance sheets further enhance its appeal as a dividend investment. For income-focused investors seeking a blend of yield and growth prospects, RS Group presents a compelling case. And the final stock on today's list is B&M Bargains. They featured a few months back, and with the recent share price drop, it was too good to not include as a must-buy for November. If you want to know more about why I believe this stock is a fantastic opportunity right now, and also why the stock price has plummeted, then please check out my recent video highlighting all things B&M. B&M Bargains, stock ticker BME, is a UK-based discount retailer that sells groceries, home goods, garden items, toys, and seasonal products, all at very low, affordable prices. The company operates over 700 stores across the UK and has expanded into France. B&M also owns Heron Foods, a discount frozen and convenience food chain, which helps strengthen its position in the value grocery market. As we can see, year to date, they are down over 50%, being priced at £1.82. They're part of the consumer discretionary industry, have a market cap at 1.83 billion, went public in 2014, have a 2-year dividend growth streak with a 5-year dividend growth rate at 4.8%, and have a current yield that's the biggest in today's video, currently sitting at 8.23%. I'd also like to add that B&M Bargains have paid a special dividend over the last 3 years, and if they do that again this year, then that dividend yield would be up at around 15%. In its first quarter update for fiscal year 2026, B&M European Value Retail reported a 4.4% increase in group revenue, reaching 1.405 billion, driven by strong performance in both the UK and France sectors. UK revenue rose 4.7% year-on-year to 1.131 billion, with France seeing a 7.6% increase to 136 million. The company opened 18 new stores in the UK and 4 new stores in France during the quarter, contributing to its growth trajectory. Like-for-like sales in the UK were up 1.3%, supported by favourable weather and Easter timings, despite challenges in the fast-moving consumer goods sector. Heron Foods, however, experienced a slight decline of 0.4% in revenue to 138 million. These results underscore B&M's resilience and strategic expansion, even after that recent £7 million accounting error. And as we can see right now, the analyst consensus is that it's a buy, with a price target of 298 pence, which would be a massive 63% above the current price. When having a look at their overall stock rank, we do see that they are the worst ranked of the three in today's video, with a stock rank at only 52. They do have a very good quality score at 65 and value score at a massive 95, and of course, due to that share price decline over this past 6 months, they do have a momentum score that sits at the lowest it can be at 1. But for me personally, I'm not so bothered about a momentum score as long as the fundamentals are still strong, and that's what I believe with B&M Bargains. And when looking at their 12-month Wall Street estimates, we can see that they agree. On the lowest forecast, they see a 55% upside with a price of 282 GBX. On the average forecast, they believe there could be a 132% upside with a price of 422 GBX. And on the highest forecast, they believe there could be a 246% upside, which is absolutely massive, being priced at 630 GBX. When plugging in my numbers for their intrinsic value, this also came out as being valued at 580 GBX, which would be a 69% undervaluation on that current price. So this is exactly why I think that B&M European Value Retail remains a notable UK dividend stock to buy in November 2025. It offers an attractive yield amid its ongoing transformation, and despite recent challenges including a 7 million accounting error and a downward revision of profit forecasts, the company continues to demonstrate resilience. With a forward dividend yield of approximately 17.89%, B&M provides investors with a compelling income opportunity. The company's commitment to returning value to shareholders is evident, having declared a special dividend of 25p every year for the last 3 years, equating to approximately £250 million in total. Additionally, B&M's strategic initiatives such as the Back to B&M's Basics turnaround plan aim to address operational challenges and position the company for sustainable growth. For income-focused dividend investors seeking high yields and potential capital appreciation, B&M presents a noteworthy consideration. And that wraps up our look at 3 discounted UK stocks to keep on your radar this November. I will continue to try and seek value with higher yielding UK stocks on a month-to-month basis, so if you found any value in today's picks, don't forget to like, subscribe, and hit that bell notification so you never miss an opportunity to grow your portfolio. Let me know in the comments which of these stocks do you think has the most upside potential. Thanks for watching, and as always, invest smart, stay patient, and I'll see you at the next one. For now, this is the Geordie Pig Investor, over and out.